RH, formerly Restoration Hardware, just released its Q3 FY2025 earnings, and the market reacted sharply. Revenue came in roughly as expected, but earnings per share significantly missed, sparking volatility. Let's break down what happened and why investors care. First up, the headline results. Revenue, about $884 million, essentially in line with expectations. EPS, 1.71, which came in about 0.45 below Wall Street estimates. That EPS miss was the standout of the report. The company also provided guidance for the full fiscal 2025 year, targeting mid-single-digit revenue growth and stabilizing margins. But the bottom-line miss brought scrutiny. Here are the key market-moving themes from today's report. Management emphasized that revenue trends remain steady, with growth aligned to expectations, but noted that profitability pressures persisted, reflected in the EPS miss. Revenue was consistent with forecasted demand in our core segments, while EPS was impacted by margin headwinds and operating cost dynamics. They also reinforced the full-year guidance. We expect mid-single-digit revenue growth and targeted margin improvement as we execute our strategic plans. These quotes matter because they show management acknowledge the earnings shortfall while maintaining confidence in long-term expectations, a balancing act that markets often react strongly to. After the report, RH's stock saw increased volatility. In fact, options pricing suggested an expected 12.3% move ahead of earnings, reflecting heightened trader expectations. Despite the revenue holding steady, the earnings miss pushed the stock lower as investors reassessed profitability expectations. Analysts also pointed out that RH has been under pressure due to tariff costs, softer discretionary demand, and margin compression, factors that contributed to the EPS miss and weighed on sentiment even with guidance intact. Looking deeper, RH operates in the high-end home furnishing space, where consumer demand can be more cyclical than broader retail. Tariff exposure and inventory costs have been on investors' radar. While revenue held up, the bottom line showed that costs and margins remain a headwind, something investors will be watching when Q4 comes around. So the bottom line? Revenue met expectations, earnings missed sharply, and today's report highlighted margin pressure in a tough consumer environment. If you're investing in RH, the key questions now are whether margins will recover and how tariff and cost pressures evolve. Like and subscribe for the latest earnings recaps, and drop your thoughts in the comments.